According to data published by SG Wealth, the 2026 RRSP annual contribution limit has reached $32,490. And every dollar sitting inside that account is carrying a debt to the Canada Revenue Agency that most retirees are systematically underestimating, not because they are careless, because the clock built into the RRSP structure is running toward a forced conversion at age 71 that permanently changes the tax calculus of every retirement income decision they will make for the rest of their lives. If your RRSP balance today is sitting anywhere above $300,000, the mandatory RRIF minimum withdrawal schedule could push your net income past the OAS clawback threshold of $90,997, and every dollar above that line is taxed back at 50 cents. And if you have been drawing from your RRSP before systematically using your TFSA, the question you need to answer right now is, how much of your own tax-sheltered wealth have you already handed back to the government without knowing it? The window is closing, and most people will not realize it until it is already shut. That last question tends to land differently once Canadians sit down and run the numbers, because this is not a theoretical risk. It is a structural feature of the retirement system that quietly separates the people who keep more of their own money from the people who quietly give it away. On that exact point, the comment section this week delivered 3 responses that reflect where a significant portion of this audience actually stands. A viewer posting as Capitol Hill Fred 64 laid it out with surgical clarity. I'm 68, RRSP just crossed $410,000, and my financial planner never once told me about the OAS clawback math. I ran the numbers last night. By 72, I'll be in clawback territory every single year. This is not a planning mistake. This is a structural trap. The weight of what Capitol Hill Fred 64 is describing is the weight of compound silence. Years of advice that never accounted for what the RRIF conversion actually does to net income. A second viewer, posting under the name Quiet Lake Retired, wrote something far shorter and far more final. Too late for me to fix any of this. Just hoping the TFSA carries me through what the RRSP cost me. That single sentence carries the full financial consequence of a sequencing decision made a decade too early or a decade too late, depending on which side of 71 you are on. And then there is the comment from Pension Watchdog _ON, which read, the government knew exactly what it was doing when it built the RRIF conversion at 71. It is not a retirement tool. It is a forced liquidation schedule designed to capture tax revenue the moment you stop working. They just let you believe otherwise for 30 years. The panic, the resignation, and the institutional anger in those 3 comments are not 3 separate emotional reactions. They are 3 different arrivals at the same structural conclusion. The RRSP is not a tax shelter. It is a tax deferral. And the bill comes due on a schedule you do not control. The origin point of this entire issue is legislative, and it was baked into the Income Tax Act long before most of today's retirees opened their first RRSP contribution receipt. The Registered Retirement Savings Plan was engineered around a single animating principle: defer tax now, pay it later at a lower rate. The assumption embedded in that promise is that your income in retirement will be lower than your income during your working years, and therefore the tax you pay on RRSP withdrawals will be lower than the tax you would have paid on contributions. That assumption was reasonable in the 1970s. It is increasingly unreliable in 2026. Here is why. The mandatory RRIF conversion at age 71 does not ask what your income needs are. It does not factor in your CPP, your OAS, your employer pension, or your investment income. It applies a fixed minimum withdrawal percentage to your entire RRIF balance, starting at approximately 5.28% at age 71 and escalating every year thereafter. By age 80, that minimum withdrawal rate reaches 6.82%. By age 85, it hits 8.51%. On a $400,000 RRIF balance at age 71, that opening minimum withdrawal is approximately $21,120, added on top of CPP and OAS before a single discretionary dollar is spent. If CPP maximum for 2026 sits at $1,364.60 per month, that is $16,375 annually. and OAS adds another $8,470 at the standard rate. The combined income before RRIF withdrawals already exceeds $24,845. Add the $21,120 mandatory RRIF draw, and the annual income crosses $45,965 before any private savings are touched. For a household with 2 pension recipients, that number doubles, and it climbs every year the RRIF balance remains above zero. But to understand why that number is almost certainly going to get worse, you need to understand what happens when it intersects with the federal benefit architecture above it. Because the clawback calculation does not care that your income is mandatory, it only cares that it exists. The moment that cumulative income crosses $90,997, the 2026 OAS recovery tax threshold, the government begins clawing back 15 cents for every additional dollar of net income. That is not a marginal rate. That is a direct reduction in a benefit you have already qualified for and are receiving. On a net income of $100,000, the clawback exposure is approximately $1,350 in lost OAS annually. On a net income of $110,000, that figure reaches $2,850. At $120,000, reachable by a household with a $500,000 RRIF balance at age 75, the annual clawback damage approaches $4,350, and the full OAS benefit is eliminated entirely before $148,000 of net income. The GIS exposure begins even lower. The guaranteed income supplement clawback rate is 50 cents for every dollar of non-exempt income above the GIS threshold, and RRSP or RRIF withdrawals are fully included as non-exempt income. For lower-income seniors who were counting on GIS as a structural income floor, a single poorly sequenced RRSP withdrawal in one calendar year can eliminate GIS eligibility for the following year with no ability to retroactively fix the damage. That is a benefit dilution effect that operates completely invisibly until the GIS renewal letter arrives and the amount has changed. There is a secondary provision embedded in this structure that most financial coverage does not focus on: the interaction between TFSA contribution room restoration and RRIF mandatory withdrawal timing. If you are drawing down your RRSP or RRIF while leaving your TFSA untouched, you are paying tax on income you could have accessed completely tax-free. And the contribution room you are leaving unused inside your TFSA compounds in your favor every single year you do not use it until the moment you do. The specific dollar implications of that timing interaction at the household level are where the real damage to long-term retirement budgets becomes visible. A household running $65,000 of combined annual income from CPP, OAS, and a modest employer pension is, on the surface, positioned below the OAS clawback threshold and comfortably inside standard federal and provincial marginal rates. Add a mandatory RRIF withdrawal of $24,000 at age 74, the approximate minimum on a $350,000 RRIF balance, and that household's net income crosses $89,000. It is now within $1,997 of triggering the OAS recovery tax. One more year of RRIF growth at even a conservative 4% return, and the following year's mandatory minimum withdrawal breaches the threshold automatically, without any action taken by the household. That is what systemic vulnerability looks like in practice. Not a sudden crisis, but a mathematical escalation built directly into the withdrawal schedule. Meanwhile, the TFSA, which this household has been leaving untouched, is sheltering investment returns that could have been drawn tax-free to replace a portion of that RRIF income, suppressing net income below the clawback line. The purchasing power evaporation in this scenario is not speculative, it is calculable. If a household delays TFSA drawdown by 5 years while continuing mandatory RRIF withdrawals, the cumulative OAS clawback exposure at current benefit levels can reach $6,750 to $14,000 in recovered OAS payments over that window, depending on RRIF size and provincial tax rates. In terms of what that number means at the grocery level, at the prescription drug level, at the home heating level, a $14,000 cumulative loss in OAS recovery taxes represents approximately 28 months of average prescription drug costs for a senior household in Ontario, or 19 months of average home heating costs in a province like Manitoba. That is not abstract wealth erosion. That is a concrete, irreversible retirement deficit created by a sequencing decision that felt invisible at the time it was made. Every year that RRIF income pushes a household further above the clawback threshold is a year the TFSA is doing nothing to protect them, and the silent tax trap tightens with every mandatory withdrawal cycle that follows. 3 structural responses deserve serious consideration at this stage of the analysis, not as recommendations, but as frameworks for the conversation every person watching this video should be having with a qualified financial advisor or tax professional before the end of this calendar year. The first is a wealth preservation question. If your RRSP or RRIF balance is currently above $250,000, have you modeled what your minimum withdrawal schedule looks like at age 75, 80, and 85? And have you mapped that projected income against the OAS clawback threshold and your GIS eligibility ceiling? The structure of that model determines whether strategic partial RRSP withdrawals before age 71 at today's marginal rates reduce your long-term tax exposure relative to the forced withdrawal schedule. The second is a liquidity protection question. If your TFSA is functioning as your primary emergency reserve rather than a systematic tax-free income source, is your cash buffer sufficient to cover 12 to 24 months of living expenses without drawing from your RRIF in a year where RRIF income would push you into clawback territory? The sequencing of which account absorbs an unexpected expense, a home repair, a health event, a dental cost not covered by provincial plans, has direct tax consequences that a pure savings rate calculation does not capture. The third is a tax exposure reduction question. Are you currently using pension income splitting to move RRIF income from the higher income spouse to the lower income spouse before the net income calculation is made for the OAS recovery tax? That single structural move can suppress individual net income below the $90,997 clawback threshold for an additional 1 to 4 years in many households, years in which full OAS benefits are protected and the TFSA continues compounding tax-free. The specific number that should be driving every withdrawal sequencing conversation you have from this point forward is $90,997. That is the 2026 federal net income threshold above which the OAS recovery tax begins, 15 cents clawed back for every dollar above that line. If your projected RRIF minimum withdrawal schedule added to your CPP and OAS income is on track to cross that number within the next 3 to 7 years, the time to restructure the sequencing is not the year it happens. It is now, while the contribution room in your TFSA and the flexibility in your pre-71 RRSP still give you options you will not have once the mandatory conversion locks in. Drop a number in the comments below. What is your current RRSP or RRIF balance? And have you modeled where your mandatory withdrawal income sits by age 75? The responses to that question will shape the coverage we do next. If this analysis reached you before the damage did, share it. Liking this video surfaces it to others who are still inside the window where the math can be corrected.